Thank you very much for making out here so early this morning to join our financial lecture forum. This morning, I'm very pleased to be able to introduce you a very special guest speaker, Professor Richard Cooper from Harvard University. He's going to give us a talk today on European issue, a very interesting subject. He's going to give us a talk on sovereign debt problem in Europe. As you know, this European sovereign debt problem has been with us for quite a while now, but we really don't know much about the real danger of this ongoing crisis. Number of questions we may have. First, when and how this European sovereign debt crisis will be resolved, and what economic cost, and what kinds of effects the rest of the world may have from this European ongoing crisis. All of these questions are very difficult to answer. And that's why we have here Professor Richard Cooper with us today, hoping that he could provide some clues on these difficult issues. Well, I suppose many of you are already very familiar with his name because he was with us several years ago to give a speech on China. And so let me very brief in telling you about his brilliant career as an academic as well as a public servant. On his bio record, he started out his academic career at Yale University right after he earned his PhD from Harvard University in 1962. And while he was with Yale, he served as provost between 1972 and 74. And he joined Harvard University in 1981, and he has been there since then. Well, while he's serving for these two universities, he took time off from time to time to serve the U.S. government on various occasions. For instance, he was the chairman of National Intelligence Council from 1995 through 1997. And he also served as Undersecretary of State for Economic Affairs during the Carter administration for the 1977 through 1981 period. And his bio is very colorful. He even served as chairman of Federal Reserve Bank of Boston in 1990 through 92. An important thing is that regardless whether he worked for the government or with the universities, he kept writing numerous books and articles, and some of them are very seminal ones. I recall when I was a grad student in the early 1970s that many of his articles were must read during the classes. So let me stop here to introduce him, and I'd like to introduce him to you for a speech today, and please join me in welcoming him.
What brings me to Korea on this occasion was a conference which was held yesterday on the international monetary system. And so if I lapse in my discussion this morning into discussions of the monetary system, it's just because it's very much on my mind from yesterday's discussion. I'll just make one comment which may be of interest to you. I was struck there were a series of panels during the course of the day from morning until late afternoon, and speaking in very general terms and with some nuanced exceptions, I was struck by the fact that the Asian speakers, whether from China or Japan or Korea, seemed to be deeply concerned and troubled by the international monetary system. And the Europeans who spoke, in contrast, not that they argued that we have a great international monetary system, but it was a livable international monetary system, and it was hard to think of, although it wasn't perfect, it was hard to think of serious improvements in the international monetary system. Now, it may just have been the selection of people, of Europeans who came to the conference and of Asians who spoke to the conference, but I was struck by that dichotomy. I was one of two Americans. The other one actually spoke about regional arrangements within Asia, and I guess my view lies someplace between that of the Asians and the Europeans. Contrary to what some of the Asians said, my own view is that the international monetary system, although it was pointed out we don't actually have a system, and I prefer the word regime. The international monetary regime was not deeply implicated in the financial crisis, in my view. A number of Asians suggested that it was, but they did not give the reasons why they thought that. My own view is that it was not deeply implicated. The monetary system itself was not deeply implicated in the financial crisis. But, on the other hand, we haven't reviewed it seriously for 35 years, since the early 70s. And my own view is that at not too frequent, but regular intervals, maybe every 10 or 15 years, we ought to stand back and take a look at all of our institutions. Are they serving us well? Or do they need adaptation? So I actually welcome the disgruntlement which has come about the international monetary system, not because I think it was a serious cause of the financial crisis, but because I think it's time to review it anyway. We should have reviewed it well before this. President Sarkozy it already started in Seoul, with the G20 last year, and President Sarkozy, who's now chairman of the G20, has put it as one of the high items on his agenda for the G20, and I actually think that's a useful thing to do. We should have done it well before now. What will come out of it is hard to say, but I think taking a serious look at it at a high official level is desirable. But I'm not here to talk about the international monetary system directly. I'm here to talk about Europe. What happened, the European financial crisis, which we date usually from January of 2010 or maybe November of 2009, was an unpleasant surprise to many people. We had this terrible period of the fall of 2008 and early 2009, a financial crisis followed by a deep economic recession. And by the second half of 2009, it looked like as the metaphor of the day was, green shoots seemed to be coming up. It looked as though the beginnings of recovery were taking place. And they weren't very strong. They were still fragile, but nonetheless, there were signs of economic recovery. And then Europe experienced this big setback, starting in Greece. Fortuitously, just by accident, because it was not related to those events, I happened to be in Athens in January of last year. And I was there for a different reason, but when I was apprised of the situation, I said, well, there's a natural solution to this. We have lots and lots of experience of the Greek problem around the world and over the years. You go to the International Monetary Fund, you arrange a big loan, and we now have a whole series of outsized loans, starting with Mexico in '94, but it included Korea in late '97, early '98. And no doubt Greece could arrange a large outside IMF loan with a supporting package from other countries, which is now the typical pattern for those things, in exchange for some serious fiscal reform, which it was clear just on superficial inspection Greece badly needed. So that was my judgment in January of 2010. For reasons that are still not entirely clear to me, the Europeans did not take that route. In fact, Mr. Juncker, the finance minister of Luxembourg, but in his role as chairman of the Committee of Finance Ministers, ECOFIN it's called, within the European community, said, no, this is a European problem, and the Europeans can solve it. Well, my heart sank. The last time I heard that phrase was in 1991, when Yugoslavia broke up, and the then French Minister of Foreign Affairs said, Yugoslavia is a European problem, the European problems can solve it. And my view on both occasions is, like hell, the Europeans can solve it. The Europeans are not set up to solve these problems. And sure enough, the Yugoslav problem was not solved by the Europeans. Rather, it got worse and worse, one bad episode after another. And finally, NATO, involving the Americans and the Canadians, had to go in actually militarily in that case to intercede. And so there's a sentiment in Europe which I actually don't quite understand. I have some hypotheses, but I don't really understand it. And so the consequence in my outsiders, I consider myself, I'm not European, but I've watched Europe for half a century now, and I consider myself very sympathetic to Europe, but still with an outside perspective. From my outside perspective, the Europeans diddled for 3.5 months and unnecessarily converted a Greek crisis into a European crisis, which it had become by May of 2010, and has remained since then a European crisis. I can't affirm for sure that if the straightforward route had been followed, that it would not have become a European crisis, because, as we know, Ireland has had some problems intrinsic to Ireland, having nothing to do with Greece. Portugal has had some problems. But the Irish problems and the Portuguese problems were greatly aggravated, and now people are talking about Spain and Italy. They were greatly aggravated by the turmoil in financial markets created by the mishandling, as I would still judge it, of the Greek crisis. At the end of the day, Greece did go to the IMF with European approval. As the Europeans looked hard at this issue and thought about it, they decided, correctly in my view, that we can't, in Brussels, we're not set up to handle this kind of problem. The IMF is set up to handle this problem. So Greece, in the end, went to the IMF, but 4 months late, 4 months later then. And I don't have to tell this group that in financial markets, 4 months, 3.5 months is an eternity. It's a long, long time, and lots of turbulence can be generated in financial markets. And as expected, the Europeans augmented the IMF package with European support funds. A special package was put together for Greece, very substantial one, 80 billion euros for a country of 10 million people, roughly. So it's a very substantial package. And basically it was designed to buy Greece 3 years' time, a three-year grace period to get its fiscal affairs in order, and to keep financial markets off its back, so to speak. And not that in the secondary market Greek bonds wouldn't be priced freely, as they were, so we could always see what the financial market reaction was. But Greece, under the program, was not obliged to go to the financial market during this period, even though it had a continuing budget deficit, but under the program receding in time. So that's where I'll come back to Greece in a moment. Greece maybe I'll mention now, Greece under the pressure of these financial circumstances largely, I have to say, in the case of Greece, self-imposed. Of course, the fact that the world was in a recession was not a good environment in which to have a crisis. And Greek export earnings, particularly from tourism, but in general, the shipping earnings were down because of the world recession. But the world recession did not, in any real sense, cause the Greek crisis. It's largely a self-imposed crisis. One, I can get into more details, if you like, about that. Anyway, Greece has undertaken a series of absolutely remarkable changes in its both in expenditures and in taxes, including pensions, things that 2 years ago, if you had said by March of 2011, is it possible that Greece could have done A, B, C, D, E, the answer would have been an unambiguous no. This is just politically impossible. And yet here we are in March of 2011, and we know what the Greeks have done. Now, when I say what the Greeks have done, I mean actions taken by the government. And as everyone in this room knows, there's sometimes some slippage between actions taken by the government and impact on the economy. And that's especially important in the Greek case with respect to taxes. The Greeks have raised their tax rates and closed some loopholes, anyway, taken some, on the whole, desirable steps. They have not yet shown up as revenues. Greece is one of those countries that has a horrible reputation for tax evasion. And so new taxes do not necessarily get translated into new revenues. So in some important respects, the jury is still out on the effects, the bottom line effects of the actions that the Greek government has taken. But the fact is that they've taken a series of absolutely remarkable actions, which, as I say, not only couldn't have been predicted 2 years ago, but if you had said this is what's going to happen by March of 2011, you would have been told you're out of your mind. It's just impossible that the Greek government, and in the Greek political spectrum, this is a left-wing government, and that may have made it modestly politically easier for them to take these drastic actions, but all the more surprising in a sense. So they've swallowed a lot of their traditional doctrine, and in order to take these actions. This is against a background, as I'm sure you're all, or at least most of you are aware, that Greece no longer has its own currency. Greece was not a charter member of the euro, which was created in 1999, but it was the first post-charter member. It joined 3 years later in 2002. So Greece has not had its own currency, and this is actually a very important background fact because the typical, around the world now, the typical set of circumstances in which the IMF goes in and country's budget has gotten out of control, so some fiscal tightening, substantial fiscal tightening, but it's usually combined with devaluation of the currency. And that's important because while the fiscal squeeze results in a negative impact on aggregate demand domestically, the devaluation of the currency with a lag of some months works in the opposite effect. And so resources are drawn from the public, or as economists call it, the non-tradable sector, into the tradable sector by the currency devaluation. That particular option is not open to Greece unless Greece were to leave the euro. And there has been a certain amount of speculation that Greece will leave the euro. My own judgment is that that will not happen, that the Greeks will live with the austerity, that it's sufficiently important to them politically as well as economically in the long run to remain in the euro area. The euro, the joining of the euro is in an indirect sense implicated in the Greek crisis because what happened, as this is not just Greece but all of the other members of the euro, what happened was that the interest that these countries had to pay on government bonds very quickly converged to the interest rate of German bonds, Germany being the biggest and by reputation, I have some quarrels with it, but anyway, by reputation, fiscally the soundest of the European countries. And so just to give you a number, between 2002, when Greece joined the euro, and the summer of 2007, so that's 5 years later, the premium that the Greeks had to pay over the Bund, the German 10-year bond, was 26 basis points, almost nothing, for 5 years. So Greece was able to borrow in European financial, well, worldwide financial markets, but mainly Europe, at very low rates by historical Greek standards. So that was one of the big benefits to Greece of joining the euro, is interest burden of the public debt fell quite dramatically. Instead of using that benefit in a constructive way, the Greeks in effect abused it by running deficits even during good years and building up their public debt. And that was one of the problems. As we know now, it was a worldwide problem, underpricing of risk in the period 2006, 2007, in the middle part of the decade, underpricing of risk. And Greece was in Greece's case, a dubious beneficiary of that underpricing of risk, and that was part of the problem. Today, Greece pays about 900 basis points. So it moved from 26 basis points. It's gone up and down, and the daily variations are often larger than the average rate that the Greeks paid during those 5 years, but it's varied between 800 and 1,100 basis points on the worst days there. And so my own judgment, this is sort of a footnote aside, is that world financial markets during this crisis and as a result of the crisis moved from very substantial underpricing of risk, which we saw also in the United States, to now tremendous risk aversion and overpricing of risk. I think that a number of what interest rates on less than first class securities now pay will turn out to be, in most cases, but not in all, and we don't know which ones are which, would turn out to be very lucrative over time. As I said, the way the Europeans handled the Greek crisis converted into a European crisis, and within a week of having put together the Greek package in May of last year, financial markets remained in high turmoil, affecting not only Greece, which now had a package, but also Ireland, Spain, Portugal, especially, to a lesser extent Italy and even Belgium. These are all countries with relatively high debt to GDP ratios. And so within a week, the Europeans had to put together a much bigger package. The headline number is 500 billion euros. And 750 billion if you count an IMF pledge. So that's essentially $1 trillion in round numbers. A very big package to be made available, if necessary, if other European countries run into trouble. And so this was to draw a term from the military, this was a shock and awe approach. The idea was to put together a sufficiently big-sounding package so that financial markets would realize that Ireland, Portugal, Spain, etc. were safe. Well, it won't surprise you to learn, we have some financial journalists in the room. Financial journalists did their homework, and they realized that the 750, or take just the European part of it, the 500 trillion, turn out on a detailed examination not to be anything like 500 trillion. There were a number of caveats and hedges, and that include pledges by all of the countries, including the countries, Spain being the most important one, that might actually have to draw on this fund. It didn't make any sense for Spain to draw on a fund to which Spain was making a major contribution. So when you pulled it all back, it turned out to be a much smaller package, still a big package, still a very big package by historic standards, but a much smaller package than the headline numbers. And so there have been ups and downs from week to week, but the turmoil has has waxed and waned on several different occasions throughout the rest of 2010 and into 2011. And sure enough, in the fall of 2010, Ireland ran into sufficient trouble that Ireland drew on this big new package now. The Greek package was separate by itself, but Ireland drew on the big new package. And there's a tendency at a certain level of generalization to lump these countries together. What they share is that they are in some financial difficulty and that the bond markets are treating them as being in financial difficulty. So we've seen the spreads rise, not to Greek heights, but we've seen the spread rise from a few tens of basis points to several hundred basis points now for several countries. If you look at them in detail, they are actually quite different. Ireland, in sharp contrast to Greece, had been a booming economy during the boom years. Like the U.S. and Britain, it had a big housing boom, and Spain, it had a big housing boom. It actually pursued a fiscal policy which appeared to be restrained. We now appreciate that given the very strong boom in Ireland, it could have even been more restrained than it was, but nonetheless it appeared restrained. And the ratio of debt to GDP was very much lower than in Greece. But the banks were in serious trouble. The banks had made a lot of development loans for construction, and during the financial crisis, the Irish government in the fall of 2008 already found itself guaranteeing hastily all of the liabilities of the banks, of the Irish banks. It was thought at the time that that was didn't make distinctions that should have been made and was probably a mistake, and so it has proven since then. And so what we've seen is Irish debt, public debt, move from modest levels, 20-30% of GDP, to much higher levels because essentially effective takeover of most of the Irish banking system by the Irish government. So it took on the liabilities of the banking system, and so it's now has a quite high debt to GDP ratio, like Greece, but not initially in the context of a IMF program. The Irish also took a series of fiscal austerity measures, again dramatic in their detail, less surprising perhaps in the case of Ireland, which is altogether a more flexible economy than the Greek economy was, with somewhat more flexible politics, but nonetheless severe fiscal measures in Ireland, not enough apparently to avoid the need for Ireland to go. It now has an IMF program with this large support package from the European Financial Support Facility. Next in line is Portugal. The Portuguese Prime Minister, ironically, has a Greek name, Mr. Socrates. He's Mr. Socrates. Mr. Socrates insists that Portugal can handle its problems. I should say the Portugal situation lies someplace between Greece and Ireland. In this sense, its debt to GDP ratio was lower than Greece's, but much higher than Ireland's. It did not experience the economic boom that Ireland had experienced. Growth was rather sluggish before then, and the budget situation was not great, not as bad as Greece, but not as good as Ireland's had been beforehand. But the Portuguese have said that, the Prime Minister in particular has said and insisted that they do not need to go to the IMF and the European Financial Support Facility. They can handle their problems on their own. That may, in the end, be correct. The markets vary in their assessment of that judgment. Portuguese pays a premium for borrowing. Portugal continues to borrow in the market, but it pays a premium, not nearly as big as the Greek premium, but nonetheless several hundred basis points above above German bond rates. I don't know whether Portugal will make it or not, but I do have to be careful what I say because I'm not an expert on actually any of these countries, and I know rather less about Portugal than I do now about Greece and Italy and some of the others. But at least on my superficial judgment, this may be one of those cases where national pride gets in the way of good common sense. My assessment, again, superficial, so on close inspection I might change my view, but my assessment is that Portugal would be wise to go to the financial facility and to the IMF. Those two things are linked now. And why is that? Portugal is going to go through an IMF-type fiscal austerity on its own, and it's not going to get any credit for it. And so it's going to have to do the measures anyway and understands that and recognizes that. And the Portuguese parliament has also taken a number of steps, not as draconian as the Greeks have done, but nonetheless they've taken a number of measures. But Portugal has to worry, if not weekly, monthly, about financial market reaction. And I think if I were advising the Portuguese government, I would say, give yourself breathing time to do this properly, get the markets off your back, and just take the loan. The combination of IMF plus European financial support. They'll save something on interest rates. The Europeans have not been generous when it comes to interest rates, it has to be said, and that is now an issue in contention within Europe. The rates that the Europeans have charged, just to think in round numbers, it's not quite right, 5%. That's way below what the Greeks would have had to pay in the market. So in that sense, it was a plus for Greece, but way above what European borrowing costs are, which are under 3%. So the Europeans are charging a penalty rate for use of this package. That actually became an issue in the Irish election. As with all elections, lots of things are going on. You can't tell, what is a definitive cause. But the previous sitting government lost its majority in Parliament, and we now have a new government in Ireland, thanks, at least in part, to the punitive interest rate, which is, in Ireland's case, was over 5%, that the Irish were asked to pay. The new Prime Minister made a promise to the electorate that he would get this interest rate down, and on the first round of discussions with of the new Prime Minister with his European counterparts, he lost that battle. Germany, and especially France, wanted them to raise corporate tax rates in exchange for concession on interest rates, and the Irish government refused to do that. Ireland has relatively low corporate tax rates, and the Irish view is that as a small open economy, they benefit from attracting foreign investment, and they do not want to jeopardize that attraction by raising their corporate tax rate. So that was a standoff. Greece did actually, in the same meeting, get a concession of 1 percentage point on the interest rates that it was paying to the Europeans on its borrowing. But anyway, to come back to Portugal, again, to emphasize, it's not a refined assessment, but on superficial assessment, I actually think the Portuguese, this is a case where national pride is getting in the way of good economic sense. And they could lock in an interest rate lower than they're having to pay, which is around 7% in the markets now, but above all, get the need for periodic borrowing from the private financial markets off their back for at least 2 years, and give them a chance to think about what would really be sensible to do without the bond market vigilantes, as they're called, looking over their shoulder, weekly about what they're doing. The really big country that is seen to be in jeopardy is Spain. Spain, like Ireland, like Britain, like the United States, had a really big, much bigger than the U.S. Construction boom in the middle part of the decade. A lot of North European money coming into Spain, buying vacation houses and retirement homes in the more temperate climate than one can find in North Germany and Sweden. And that bust during the crisis, and that was a big letdown for the Spanish economy. Spanish budget in normal times, like Ireland, unlike Greece, and with Portugal being in between, Spanish debt to GDP ratio was not especially high, and the budget was relatively well managed. But as in the case of Ireland, Spain found itself with lots of really bad bank loans. Not in Spain's case, unlike Ireland and Britain in this context, not in the major banks, which Spain has some really big world-class banks, and they got through the crisis reasonably well. But Spain has a lot of savings banks called Caixa, and these banks had made a lot of building loans and mortgage loans, and it was the Caixa, of which there are several hundred, although they vary a lot in size, which are in trouble. And so the Spanish government is now wrestling with the problem of what to do about these financial institutions, how much to salvage them, how much to have forced marriages, mergers with stronger institutions, how much to let them go. And that's an ongoing process. Unlike Ireland, Spain has not sort of taken over all of the bank liabilities. So they are not formally on the budget or the debt of the Spanish government. But it's an issue of concern because nobody knows quite how this is going to come out. And it depends on both the actual conditions. These are many of these are non-transparent, non-public institutions, often with complicated ownership structures owned by trusts, which are themselves somewhat opaque, or even owned by local governments. And the rules on transparency on local governments, believe it or not, are less than they are for publicly traded corporations. So there's a lot of just sorting out the numbers, and then once you understand what the numbers and the risks are, the Spanish have to figure out what to do about it. So that's all in process at the present time, and the markets are uncomfortable about the Spanish situation, and the premium that the Spaniards have had to pay on their public debt has gone up very significantly, but still way below Greece, Ireland, and Portugal in that respect. So that's where we stand in terms of the countries, and then lying behind that is Italy, which has a very high debt to GDP ratio, Belgium, which has largely escaped notice up until recently, but I've noticed that the financial press has caught on to the fact that Belgium actually has a very large debt to GDP ratio. So now people are looking much more closely at those countries. Italy, of course, has its, both countries have serious political problems. Belgium doesn't have a functioning government, and Italy has a government which at least The Economist magazine under Berlusconi thinks is not functioning well. Berlusconi, not surprisingly, has a different view than The Economist magazine of his premiership. So there's still a lot of queasiness, I guess is the way to put it, about Southern Europe. Not the northern countries, but the southern European countries. Every once in a while, questions are raised about Britain. All the countries I've mentioned so far are in the Eurozone. Britain is not in the Eurozone. Britain, the British pound, did depreciate sharply. So that's from a aggregate economic, macroeconomic point of view, that's actually helpful to Britain. Not to its continental trading partners, but it's helpful to Britain in this. So the situation is somewhat different in Britain. I won't comment further on that unless we want to raise it in questions. So that's all on the sort of individual country market front. In the meantime, the European senior officialdom has been stewing around. I want to mention one further thing. The European Central Bank, which is founded with the charter, wrongfully in my view, and I've been a critic of the Maastricht Treaty since it was signed, since before it was signed, places the prime objective of the European Central Bank is price stability. No mention of financial stability. In my view, is that the prime function of a central bank is to preserve financial stability and be a lender of last resort. Not mentioned in the Maastricht Treaty. I mean, it's astonishing. Fortunately, the ECB has been in the hands of seasoned central bankers, including, above all, Trichet, the chairman, but his colleagues are all seasoned, I would say, old-fashioned central bankers. And they recognize a crisis when they see one, and they have acted astutely, starting already in August of 2007. The ECB flooded the market. Remember when we saw the first freezing up of the commercial paper market. The ECB flooded the euro market with liquidity temporarily in August of 2007, and much more massively in 2008. All very sensible in my view, the kind of thing that central bankers should do, but which are outside the charter of the European Central Bank, astonishingly. So I worry in the long term we go through another 2 generations of leaders. There will be people who are young now grow up to the leadership positions, and they will have grown up in the Maastricht environment without the experience of people like Trichet. So I think there's a possible long-run problem there, although this experience of the last few years is a learning experience for some of the younger people coming up through the system, the future leaders of the system. Anyway, among other things, the European Central Bank, just back up a bit on a technical issue. Unlike the Federal Reserve, which in normal times runs monetary policy by buying and selling U.S. government securities outright, they have a repo market also, but the main thrust is outright purchase. And of course, in a growing economy, that means the stock of U.S. Treasuries held by the Federal Reserve has grown over time. It fluctuates, but it's fluctuated around a rising trend. The Europeans had this hang-up, particularly when they were writing the Maastricht Treaty, which is now, we're talking about 1991, so that was 20 years ago, had this hang-up about central bank financing of government debt. So their modus operandi is different. It's through a repurchase agreement, and the central bank, Frankfurt, engages in its what we call open market operations through repurchase agreements, and the eligible paper for these repurchase agreements is actually decided by the national central banks. So the Bank of Spain determines which Spanish paper is eligible for repurchase or rediscounting, if you like, by the central bank, and the Bank of Italy determines the Italian paper and so forth. Obviously, there was a problem when the market essentially froze up on Greek debt. So, again, sensibly in my view, but against all of the rules and I would say the philosophical principles, not against the formal rules because they had legal authority to do it, but against the philosophical principles of the European Central Bank, the European Central Bank began to intervene in government debt, public debt. Most of their repurchase agreements are actually private loan, normal bank loans, which banks, short-term bank loans. So now the ECB holds a very substantial amount of government debt, Greek, Portuguese, and so forth. It's been supporting the secondary markets. These operations are special only in the sense that the eligible paper that they've cumulatively built up has been public debt. Their modus operandi is the normal one of repurchase agreements. And then came a rating downgrade of Greek debt to make it what would have been ineligible for rediscounting under the ECB rules, and so they changed the rules. And they now allow themselves to do repurchase agreements in debt that is, at least by the rating agencies, below the standards which they have traditionally used. So the ECB is fudging on a series of margins, and the ECB has come under heavy criticism, especially in Germany, but not only in Germany, for this fudging. I am much more tolerant of such fudging. I believe that good central banking involves the exercise of discretion guided by the circumstances of the moment rather than hard and fast rules. And so I'm not one of the big critics of the ECB on this count, but it does actually create a practical problem, because now the ECB is a substantial holder of call it doubtful debt, government debt of some of the southern European countries. That makes the ECB an interested party in the outcome in a way that it wouldn't otherwise be, in particular on the question of restructuring the debt. Is the ECB included or not? And if it's not included, what would be the possible grounds for excluding it if there is a restructuring? People talk about default of the Greek debt, and a number of people, the one that I know just because he's an old friend of mine, and now the lead economist at Citibank, recent hire, Willem Bouter, a Dutchman by origin, but basically lives in the middle Atlantic. He's partly British and partly American by thinking and sentiment, and very outspoken. He just insists that on his analysis there is no way for the Greek government to avoid default. Smaghi, on the other hand, who's he's a member of the ECB Council, Italian by nationality, but speaking on behalf of Europe, has been outspoken on why Greek default is highly undesirable and should not take place. And European officials generally don't like to talk about it. I consider default a very harsh word. A much more gentle word is restructuring. We now have lots and lots of experience around the world with restructuring debt. We've done it in some cases very badly. Argentina is, of course, the Exhibit A. That was unilateral on the Argentine part. And we've done it in some cases so smoothly that we don't even know about it now, except specialists who are into this business. And I do not have a judgment. You have to get deeper into the figures than I have done about whether the Greek debt at the end of the day will need restructuring. That, I think, at the end is an empirical question, what the numbers show. I do have to say that with Bouter, I think the numbers do not look good. The Greek debt, the target in the IMF program was by 2014, Greek debt should stabilize at 140% of GDP. That already is a high number. If you're paying 5% on your public debt, that's already 7% of GDP in debt services. But then it turns out that there are complicated definitional questions about when debt is public debt and when it isn't, particularly when state-owned enterprises are important, as they are in Greece. And the current with the revisions, this is not a Greek error, but just looking finally at what counts and what doesn't count. Greek debt looks like it'll be over 150% by 2014. So the situation does not look good. I do have a view on the question, which is the following, that we shouldn't decide now. We don't have to decide right now. Greece bought 3 years from May of 2010, and I think it would be unwise to wait the whole 3 years. Bond markets are not that patient, but I would wait until next August and see what the Greek government has actually done. There are some things they're supposed to do this year, actually this month, which haven't been concluded yet. See what they've actually done, and especially see what the impact of those actions has been on fiscal flows, both revenues and receipts, and see what the European recovery looks like between now and the third quarter of this year, because the state of the European economy overall is a heavy environmental influence on Greece. So I would wait until next August and then put the IMF and the Brussels and the Greek teams together to do an assessment about whether it's conceivable that Greece can avoid a restructuring. And if the answer turns out to be no, as I say, I don't have my personal answer on that question. If the answer turns out to be no, then begin to think about how to do it as smoothly as possible. It's not the end of the world. It does have this special problem now about whether the ECB should be included in any restructuring. I think the answer to that has to be yes. But anyway, that's something for the Europeans to determine by themselves. I went to 4 conferences last July in Europe, and 3 of which were on the European financial, well, directly or indirectly on the European financial situation, and I was struck by the tremendous pessimism of the Europeans at those conferences. Again, you never know at conferences. There's a small numbers problem. There's a selectivity issue. I found myself, as somebody from across the Atlantic, being the cheerleader for the euro in this otherwise pessimistic group. The euro area was going to fall apart. In my judgment, it will not fall apart. That is not. It is literally conceivable, but it's, as a practical matter, it's not going to fall apart. Will Greece leave the euro area, which is, widely mooted as a possibility? My best guess is not. If you look at the practical details of leaving the euro area, they are horrendous. Restructuring the debt is a piece of cake compared with leaving the euro area. Will Germany leave the euro area? That's another thing that's mooted. Germany's paying all these bills, at least as seen by the Germans. By the way, the Germans greatly exaggerate the fiscal burden on them. But anyway, this is a political issue that Chancellor Merkel has to face. Will the Germans leave the euro area? In my view, certainly not. All of these are sort of, they're worse than worst cases that people imagine when they're very pessimistic. So I think that the euro area will hold together intact. Indeed, since that time, we've seen Estonia join the euro area, and other countries are lined up. Latvia is complaining because it has not yet been admitted into the euro area. There's now talk in Denmark about whether they should join the euro area. During the financial crisis, sentiment in Denmark swung heavily in favor of joining the euro. Since the Greek crisis, it swung back the other way, not surprisingly. But anyway, I don't think the euro area is going to fall. Greece, and if it comes to that, Portugal, and with important differences, Ireland, are left with a serious problem, which is, again, Greece is the strongest case, but it's also a problem in Italy, and it's a problem in Portugal. These countries are uncompetitive within Europe, where they share a common currency with Germany and the Netherlands and other countries. And even internationally, of course, that depends on what the euro exchange rate is against the dollar and the yen. But this is to make an analogy, this is a classic gold standard kind of case where international competitiveness has to be assured through macroeconomic adjustment, I would say, not necessarily policy, but adjustment, and not through changing the exchange rate. That particular route has been ruled out by being a member of the euro area. So I think that Greece is going to have a rough decade ahead of it. I think that the public sentiment in Germany is correct, which is the Greeks have been profligate over the last decade. Where I differ from the Germans is that my view is just because somebody is profligate does not mean you don't try to help them, but you have to do it. You have to do it in the proper way, and so just one further remark, and I'll conclude and invite comments and questions. While all of this is going on, the Europeans have been stewing at the European level. We have a new situation. What are we going to do about it? They patched together an ad hoc arrangement for Greece. Very quickly, markets signaled that that was not sufficient. Then they patched together this much bigger package, which I've mentioned. That is due to expire in early 2013. It has a sunset clause. And so the Europeans have been wrestling with what, if anything, is going to succeed the European stability, whatever it's called. So they have been wrestling with that. There have been big disagreements, mainly, to oversimplify, between the northern and the southern European states on what should be the content and the modus operandi and the details of that that package, and the Europeans have been groping toward a solution to that. It was supposed to come by the end of this month, and it may still do, remains to be seen, but it was originally supposed to come by the end of January, and it's been postponed, and I will not be surprised to see it be postponed again. But they're gradually converging. I mean, they're ironing out the disagreements. In the meantime, they have made the 500 billion euro package real. So they made two concrete decisions. One was to lower the interest rate for Greece, and the other was to, against some conditions that Greece behaves in a certain way, but these are things which were part of the Greek program anyway. This is just reinforcing the need for Greece to do it. And secondly, they have made the 500 billion euro package real, not just a headline package, but they've actually filled it out so that they have more money. The big issue there is Spain. They can handle Portugal comfortably, but if Spain were to come in for a big loan, that's something would have been problematic, possibly problematic under the old region. So they have, on the interim agreement that still lasts a couple of years, they've loosened up a little bit, and there's some other technical areas where they've loosened it, and they are converging toward agreement on an ultimate, a long-term package. And so that's on one front, the sort of financial support package, and then the other front, which is linked to that, is what governance arrangements do we want to insist on as a condition for having access to this package. And this has to do with essentially international, meaning not IMF, but Brussels review of the fiscal policies of the member states. There's a general feeling, which I actually do not share, that they need much, much closer fiscal coordination. More fiscal discipline I do share. Greece was just off the reservation. But more coordination, I think, is highly doubtful. But anyway, that's the current sentiment in Europe. It's hard to sort out two things always with the evolution of Europe as a whole, because there's the substance of the issue at hand. In this case, to what extent should we Europeans coordinate the national fiscal policies? And I will just comment on the side here. I think that's highly problematic from I'll even call it a philosophical point of view. The absolute heart of democratic government is taxes and budget. And the more Brussels gets in the middle of framing budget and taxes, there was one proposal, which I think will go nowhere, that Brussels should be apprised of and approve the budget before it is submitted to national parliaments. Well, from a democratic theory point of view, that's just an outrageous. But the Brussels bureaucrats have proven themselves on previous occasions to be insensitive to such considerations. So there's the substance of the issue, and then there's the not so hidden agenda, although it's more hidden now than it was 40 or 50 years ago, which is what is Europe going to look like in the long run? There was a time in which Europeans talked openly about the objective of a United States of Europe, by very rough analogy with the United States, a federal system with lots of devolution of authority to the member states, but nonetheless within a federal framework. That was debated hotly from the beginning. I mean, it was never open and shut, but at least there used to be open discussion of that. That has just disappeared now. The notion of federalism is not explicitly on the public agenda, but it hasn't gone away either. And so there are forces within Europe, and particularly in Brussels, but not only in Brussels, who are constantly looking for occasions to push the federal, these are my words, not European words, but to push the federal agenda. I'm not sympathetic to those, because I think if I were a European, which I'm not, I probably would be a federalist. But of course I'm an American, and so I'm comfortable with a federal, with dual citizenship, so to speak. I'm a citizen of the United States of America. I'm also a citizen of the Commonwealth of Massachusetts. That does not sit well with the French Cartesian view of an orderly world, but we Americans have become very comfortable with a disorderly world. What is formally a disorderly world? As long as it works, we're not troubled by the relative disorder of it. But I'm not a voting European. But nonetheless, the federal agenda has not gone away. And so you find in every new crisis, you find some folks using the crisis to push the federal agenda. And so these two things are getting mixed up, and they're commingled, and it's hard for anyone, insiders as well as outsiders, to keep them separate.
Thank you, Professor Richard Cooper. I learned a lot from your presentation. I have two questions. One, if those problem countries, what they call the PIGS countries, Southern European countries, have been able to implement monetary policy. They've been the problem's been taken care of from the beginning. That's the first question. Because after they joined the euro, they could not implement the monetary policy. The second question, having witnessed all the troubles in Europe, after they formed the euro or Euroland, would Turkey be still interested, or they desperately want to join the euro?
So there's not much that, there's a little bit, but it is only a little bit that an independent monetary policy could have done beyond what's been done. Now, that may not continue to be true. There's talk now that at the next round the ECB will raise interest rates, and we may see some gradual tightening, which of course will aggravate the situation. But the fact is, throughout this period, European monetary policy has been exceptionally easy. I think the big loss in this particular episode has been the freedom to change the exchange rate and not monetary policy. And I have to say that in the case of Greece, especially, that in a sense that intellectually that's the easiest case. They just had lost all fiscal discipline, and no matter what, even if they had a completely independent central bank, their central bank would be telling them you have to get control of the budget again. So I think that's just unavoidable under any circumstances. It would be economically easier, less hard on the Greek public, if they had a currency that they could depreciate. I think monetary policy would make a difference. Turkey. I'm not an expert on Turkey, and I do not know what is happening now. The current government, under a party which some people call a religious party, it is actually not a religious party, but it's more sympathetic to the principles of Islam than other parties have been. Turkey, since the 1920s, has been a fiercely secular state. And I use the word fierce advisory, and it's been enforced by the army. And we have now the current prime minister, who is a very skillful politician. He's trying to make Turkey more receptive to open adherence to Muslim without making it a Muslim state. Turkey applied for membership in the Union. The Europeans put down a number of conditions for membership in the Euro, most of which are perfectly sensible. The Turkish government, the current prime minister's government, because he's been in power for some years now, undertook a series of legislative actions, and sometimes the legislative actions are actually backed up by administrative actions, well, that's not always the case. Designed to facilitate membership in Europe. And the Europeans, who are strongly divided among themselves on the merits of Turkish membership, in the Turkish view, have not been receptive to all of these, what from a Turkish point of view are major changes, including some constitutional changes. And so what I detect is a certain disillusionment among the European-oriented Turks about membership. And the government, we know because we read it now every day, the Middle East is in some turmoil, and Turkey could play a potentially very important role there. The foreign minister is an academic by background, and he wants to be friends with all of his neighbors, including Syria, which there's been some hostility between Syria and Turkey, including Iran. There's been some hostility. So, at least outwardly, Turkey appears to be turning its attention from Europe, heavy focus on Europe, more to the regional area. And some people are interpreting that as the Turks are backing away from Europe. I don't know enough about Turkey and the internal politics of Turkey to have a view on that. But what we observe in external Turkish behavior is much more attention to non-European affairs, particularly in the last 2 years, than was true before then.
Professor Kupos, I have been yesterday's seminar and I heard of your comment at the seminars which was held yesterday. I have 2 questions. First one is about SDR. How do you evaluate the EU's members' evaluation and attitude about SDR for the expansion and some more functionality currency as a substitute or supplementary to US dollar as a key currency? That's one question. The other one is this year France is a G20's presidency countries, and thereby we have learned that France promote in collaboration with China some of the different position or weight of key currency as the US dollar, and promote support for yuan, some further increase the role of as a key currency or some participation. For these 2 subjects, would you explain?
Over half a billion people there, and on any given issue you can find not a European view, but many, many European views. And I think it's fair to say that with respect to the SDR, most Europeans, and I'm not only talking about the man in the street now, but even more educated Europeans, have given the SDR no thought whatsoever. And so they don't have a view on the SDR. Historically, I should make a confession, which is I was involved many years ago in creating the SDR. So I claim sort of I have some grandfatherly sentiment favorable to the SDR. It does not mean I'm strongly committed to an SDR, but I have this nostalgic sentiment for the SDR. So found myself in the position pushing it in various regards. Historically, the German government has been the most hostile, and the German government views were driven by the Bundesbank views. Now, the Bundesbank still exists as a German central bank, but it no longer has the main central banking functions. They've now moved to the ECB. And I haven't talked with people in the Bundesbank about this issue for years and years and years. But I would not be surprised to find initial almost gut reaction from Germany to be hostile. Why is that? They think SDR creation would be inflationary, and they're worried about anything that's inflationary. And I, on request from the IMF, actually written a paper on this subject, and one can imagine scenarios in which the SDR would be inflationary, but they are extremely improbable. And the most probable scenarios, which assumes that the ECB and the US Federal Reserve and the Bank of England, the Bank of Japan, the leading central banks, all keep their eye on domestic inflation. The formal term which the British have actually formally adopted is inflation targeting. As long as inflation targeting or something close to it takes place, the SDR in the major countries, the SDR just will not be an inflationary. So, but it's necessary to persuade the Germans of that, and that's a process which has actually started now. So I don't know how it will come out. I guess my bottom line judgment is that while I favor giving the SDR a more prominent role. And by the way, a well-kept secret is that is the official view of the international community. We have 183 countries who have signed on to the proposition that the SDR should become the centerpiece of the international monetary system. Back in 1978, we've all signed on to it. Korea has, the U.S. has, Germany has, but it was neglected, like a number of treaties was neglected. So anyway, I support pushing it forward, but I have to say I do not. If I were looking at the agenda of the international monetary system, this issue would not be at the top of the agenda. I think there's some easy things we can and should do. There's some harder things that would require very tough negotiation, and I'm not sure the gains would be worth the toughness of. I think I can think of more important items, I guess is the way to put it. On the role of the RMB, there are, I guess, let's say 3 issues. One is the internationalization, in quotes, of the RMB, and the Chinese have started that process. And if one puts a metric on it, they have this far to go, and they've gone about this far. I mean, they're proceeding very, very cautiously. They are proceeding, they're getting their feet wet, they're gaining some experience. I think that's all to the good. If you talk to Chinese now, they seem to have ambitions which go way beyond that. And my reaction is a simple and straightforward one. Until the RMB, or the yuan, becomes fully convertible, it's not going to become an international currency. More concretely, foreigners, non-Chinese, have to be able to hold assets in RMB if you want foreigners to use the RMB. And at the moment, the number of assets that foreigners can legally hold in RMB are limited. They're not zero. You can now have a bank account in Hong Kong, but they're very limited assets. So I think the Chinese have a long way to go before the RMB is really becomes an international currency. And it is intimately linked to reform of their domestic financial system. And that, in turn, I hypothesize, is intimately linked to local central relations within the Communist Party. So this is not an easy issue for the Chinese to address in a serious way. Now, the third issue sounds like a more technical one, which is the SDR is now defined in terms of 4 currencies: the US dollar, the yen, the euro, and the British pound. It used to be the French franc and the German mark, and of course they've now disappeared in favor of the euro. And some Chinese have raised the question about whether the RMB should be added to the SDR. I'm actually opposed to that, so long as the RMB is not convertible. But my opposition is predicated on wanting to keep open the option that the SDR could become much more important than it is, and in particular be used by the private sector. And if you want to keep that option open, then I think you have to have only convertible currencies in the RMB for all of the financial instruments that would make arbitrage possible and so forth. If you're willing to foreclose that option, not forever perhaps, but for some time, there's no technical reason why the SDR as it exists today could not be made to work, because it's just among central bankers and the IMF, with an inconvertible currency in it. But as I say, it would foreclose an option that I would like to keep open. The other question to ask is, what would be gained by putting the RMB in the SDR? And as far as I can tell, nothing would be gained by it. As long as it's linked to the dollar, you don't increase the diversity of the SDR at all. On the contrary, you just increase the weight implicitly of the dollar. And so that's related to Chinese exchange rate policy. And so I don't see any gains to be had except for puffing up Chinese pride a little bit, again, insofar as people know about the SDR, which does not include most people. And as a general proposition for any country, I'm opposed to taking serious steps in order to enhance national pride, if there are no other gains from it. So.
Thank you very much for your very good lecture, especially on the topics of European issues which we have pretty limited access My curiosity and question is that while that you indirectly mentioned briefly that I feel very curious about the long-term status of euro as a currency, if it can remain as common currency of European countries. That among European euro individual countries, international competitiveness and productivity between countries are vastly different, and there are big differences. And in that case, and they have huge differences in balance of payments and current accounts. But individual countries' perspective, while they may have fiscal policy options, but they do not have a monetary policy, and they do not have any control about the exchange rate. So, and under this kind of situations, euro money can remain as one currency, or if they may have some damage.
About whether their moving to a common currency was actually wise on the part of the Europeans, largely on grounds that you suggest there's a tremendous amount of diversity and you're taking away from individual members important instruments of policy. The Europeans decided, I think, partly on economic grounds neglected by the economics profession, namely the efficiency gains from having a common currency, which if you look at the economic discussions are almost unmentioned. And there's an intellectual reason for that. In their modeling, economists assume perfect, cost-free, efficient markets. Anyone who lives in the real world knows that markets are not cost-free and efficient. Just take the financial industry, of which I assume some people in this room are members. On the economic models, there should be no financial industry. All transactions, buyers and sellers would be perfectly matched, no transactions cost. An entire industry would just be disappeared if the models which economists use are correct. And so I think the economics profession has understated the importance of transactions costs and hence the gains in having a common currency. But that does not settle definitively. I mean, it's just one argument on the other side. But if I'm to make an unconditional forecast, my guess is the euro will stay together. The political support for it is so strong. There have been serious gains, largely in the efficiency. And the Europeans have become, this is a change in my lifetime, the Europeans, meaning the bureaucrats in Brussels, have become fierce advocates of competition within Europe. And they've really taken on the role which the U.S. antitrust division used to have, but now it's moved to Brussels in terms of the fiercest enforcer of competition. And they see this as a powerful contributor in their task, where people can compare prices directly for a given product in Italy and Germany and so forth without worrying about currency conversions. So my guess is that it will remain for a long time. As I've said, I think Greece is going to have an uncomfortable decade, but I think Europe and the Eurozone will survive this crisis and even thrive in general. And the euro, for a variety of reasons, is attractive for other people to hold. And it's a solid currency, and its inflation is low. And so I think you'll find many countries, of course the members of the European Union, not members of the Eurozone, they will increasingly use euros, informally if not formally. And other countries like Ukraine, which are Turkey, which have strong economic ties with Europe, I think you'll find using the euro. So my expectation is that to just use one index, the share of currencies in international reserves, my guess is that the share of euros will gradually rise for a while. Having said that, if you look at long-run trends, Europe is in serious demographic decline. And so Europe's share of the world economy is going to decline. The same is true of Japan. Same is true of Korea, for that matter, and China, but other circumstances are different. But the mature economies, Europe and Japan, are in long-run demographic decline. And I think, so they will gradually, over the decades, just become less important in the world economy. So that cuts in the other direction. In that respect, there is actually a marked difference between Europe and Japan on the one hand and the United States on the other. The United States is not in demographic decline. The birth rate, as in most countries in the world, has fallen in the United States over the last few decades, but it has not dropped below the net reproduction rate, what demographers call the net reproduction rate. And so the U.S. population through natality is just stable. And then on top of that, we have over 1 million immigrants a year, legal and illegal. And my own view, not all Americans share that, but my own view is that the immigrant population is a tremendous source of vitality for the American economy. And so the U.S. is in a markedly different long-run situation from Europe and Japan. And not surprisingly, Canada and Australia are someplace between. Birth rates have fallen more in Canada and Australia than they have in the U.S., but both of those are countries of successful immigration, which gives them some, again, a source of vitality, which Europe and Japan don't have.
Yeah, your lecture is very interesting, and you provide different reasons why Greece has difficulty, and then Ireland, and then Portugal. My question is why European countries face such difficulty in a short period of time from one country to another? It's due to global financial crisis or common currency, or it seems like a phenomenon of contagion. How do you explain?
The recession, the downturn in economic activity. Of course, this is an aggravating circumstance for everyone. And to have your own domestic adversity in an adverse international environment just makes things a lot worse than if you have domestic difficulties in a period of a buoyant world economy. So there's no doubt that the world recession is an aggravating circumstance. But in the case of Greece, and I want to emphasize that now somebody mentioned the term pigs. It's not an expression I like, but this lumps all these countries together. Well, as I've tried to suggest, if you actually poke around in relevant details, there are important differences among them. But in the case of Greece, I think it was just a case where there was a great new opportunity created after joining the euro in the decline in interest rates that the Greek government had to pay, and they misused that opportunity. So I think that's the basic story. Greece is not alone. We saw an analogous situation in Argentina in the previous decade. Some of you will recall that Argentina, having had decades of financial crises, Argentina adopted a currency board arrangement, a new currency and a currency board arrangement with the U.S. dollar in 1991. And Argentina had 5 or 6 very good years in the early 90s. The economy was buoyant and going very well. They had an adverse shock. They had not a customs union, but a quasi-free trade area, preferential trading arrangement with Brazil. Brazil was caught up in the global financial crisis and had to depreciate the currency in early 98. And that was a big shock to Argentina. And then Argentina, the currency board collapsed in late 2001, early 2002. Now, if you look at Argentina closely, what was going on? Well, they did have this adverse external shock with the Brazilian devaluation, and I think that, in my judgment, has been underrated. But the main thing with Argentina was similar to Greece, namely fiscal indiscipline. They never got their budget under control, and paradoxically, having had a successful monetary reform, greatly lowered the interest rates which the Argentines had to pay for their outstanding debt, both domestically and internationally, because they sold a lot of the debt domestically. And instead of using that occasion to assert serious fiscal discipline, because it was cheap to borrow, they ignored it. So I think that was, if I had to point to a single factor in the case of Greece, I would do that. And then you can just go through the list of details. I mean, public civil servants in Greece get paid 30% to 40% more than private people in exactly comparable jobs. So the public payroll has been padded. The patronage system worked under both governments, both the right-wing and the left-wing government, so the Greek government payroll was much bigger than it needed to be to provide the public services that the government was providing. Pension, which is a source of special irritation in Germany, people could retire at full pensions at a relatively young age before reaching the age of 60. And you can just go through, there's a list of things where the Greeks, I mean, to put it one way in McKinsey terms, the Greeks were not paying any attention to, at least in their practice, I'm not talking about intellectually, but in their practice, to best practice around the world. We now have lots and lots of experience. The IMF in some areas pulls that together. It's available. The OECD pulls it together. The World Bank in other areas pulls it together. So any country that's interested can look around and find out what best practice is in a particular area of public policy. And the Greeks just weren't interested. I mean, that's the bottom line. They weren't interested. And as long as the boom went on, everyone was comfortable.
Professor, I would like to introduce our experience during the financial crisis from 1997 to 2000.
Make it very quick. Make your question very straight.
Yeah, you couldn't introduce the European people's their sentiment, their any kind of campaign. During the financial crisis in our countries, we had a gold collection campaign. Can you remember? Among the housewives, they collected $1 million amount of gold to support our lack of foreign reserve. And then, as you know, during that time we had very competitive industries, as well as durable, construction, automobiles, petrochemicals, many others, more than 7 kind of competitive industries. But we didn't have money, huge debts in our countries. And then IMF supported to our countries. They sent their officials to our government, they dispatched it, and pressed to reduce the liquidities and raise the interest rates and reduce the salaries, many kind of things. During the time, our the interest rate was 42% annually, and our current exchange rate $2 to $1. Very, very difficult situation we experienced. But we recovered from that very, very serious crisis in our history. Now, as we know, Korea now, we hosted the G20. There's some meetings here. Would you please introduce those countries? If we want to recover this kind of financial crisis, you need to have this kind of thing. Only strong demonstration industry can't help you.
Okay. Korea had the advantage, which Greece does not have, of moving the exchange rate. And that was actually a big factor in Korea's recovery in 1998. And that particular factor is excluded to Greece by their own choice. But I mean, no, but that's the reality at the moment. So that particular relief valve, and that was against a background of Korea at that time being more export-oriented than Greece is today. And then Korea could take advantage with the fiscal austerity and the tight monetary policy, but the exchange rate provided, from a macroeconomic point of view, provided a safety valve, which is not. Yeah. Well, I remember that. I remember several things about that crisis. The one that I remember, I've never been high on the rating agencies, and my esteem of the rating agencies did not go up during the last several years. But what I remember particularly is they downgraded Korean bonds, and I thought anyone who knows anything about Korea, and I'm not an expert on Korea, but I had done some work on Korea, knows that the Koreans will bring in the jewelry of the households in order to avoid default on the bonds. And the rating agencies, as it said pejoratively, the ratings are made by 25-year-olds, supervised by 40-year-olds, and they know how to massage the numbers superbly, but they don't look beyond the numbers. And Korea was a case where they just didn't look beyond the numbers. And so I remember that particular episode, and I do remember the gold collection. But that was really unique to Korea. I don't know of any other country that has done that.
Okay. Do the news media alleviate or exacerbate economic crisis by reporting?
In fact, they aggravate both the ups and the downs. But I don't blame the media. I blame the financial community for paying too much attention to the media. The media, we have to remind ourselves always, are not in the position of objectively reporting the news that may be of interest to you and me. They are in business. And they have to keep their eye on the typical reader. The typical reader likes dramatic headlines, is attracted by dramatic headlines. So issues that in context are entirely manageable can become a big black headline in the media. Then, unfortunately, people in the financial community read these headlines and they sell before thinking. And that's what creates the volatility, is they read the headline. The one thing I know is that everyone else is reading the same headline as I, and I want to get in before the other folks get in. So sell first, and then think about what I've done. That's a source of volatility. So it's the interaction between the media and the traders that one has to take into account, not just one or the other.
That will be the morning lecture today, but I have a couple of questions from the floor, written question. Among these two, I will ask you one simple question. Well, simple, but it's very difficult question probably. About British pound. What do you think about the British pound? If you were leader of Britain, finance minister, you will keep the pound outside of euro, and what do you think in the long run or in the medium-term run?
My long-run forecast, and I made this already a decade ago, so one could say that we're in the long run now, is that Britain will join the euro area. It has not come to pass. The current government, the new Tory government, of course, is much more hostile to joining, in fact, to Europe in general, but particularly to joining the euro area than the previous government was, and the previous government was divided. And of course, the developments of the last year are going to provide valid arguments, I think, in Britain for not joining the euro area. So I guess I would still make the long-run prediction that Britain will join the euro area, but the long run is longer than I originally thought, thanks to both political developments inside Britain and to external developments, but highly relevant to that decision. It would not be, when the time comes, it will not be an easy decision. Now, there is one strongly mitigating argument which will take the pressure off joining. When the euro was created, there was a lot of concern that the impact, which I did not share, by the way, but there was a lot of concern that there would be a strong negative impact on the City of London, the financial center in London. And what I thought, and has proven to be the case, is that the City of London has proven that it can work just as well in the euro as it learned years ago it can work in the dollar. It doesn't need the British pound in order to thrive. And sure enough, the main market in Europe, the main international market in euros, is not in Frankfurt, it's not in Paris, it's not in Amsterdam, it's in London. And so that particular source of pressure inside Britain for joining the euro has been diminished because the city has learned that we can make all of our fees operating out of London, even though we don't carry euros in our pockets.
Okay, thank you so much. We have read a very long this morning lecture, so let me close at this time, at this moment, that all this morning lecture here. Thank you very much for being with us.